I read all 334 pages of Tony Robbins' new book, The Holy Grail of Investing. And if you could get past the sense that it's all a sales pitch to invest through a company that Tony is part owner in, you can learn quite a bit about the world of alternative investing that so many people are talking about. The big premise of Tony's book is that there is a holy grail of investing that Tony learned from Ray Dalio, the famous hedge fund investor. The Holy Grail is a portfolio of 8 to 12 uncorrelated investments, which together will dramatically reduce risk without sacrificing returns. Tony states that this kind of portfolio can reduce risk by as much as 80% while maintaining the same or similar upside potential. Now, anytime someone tells you that you can get great returns with low risk, when they tell you something that sounds too good to be true, that's probably a sign that it is too good to be true. Tony tells you that this holy grail is available to the rich through something called alternative investments that aren't typically available to regular everyday folks. Then he describes those investments and how to buy them through a company that he's part owner in. Now, Tony is more famous than me and probably richer than I am. So despite viewing this book as a long investment pitch to buy investments from Tony's firm, I was curious to learn more about the 7 investments he describes in his book. The first investment Tony talks about are GP stakes, which are minority investments into the general partners of private equity and hedge funds. When you invest into these types of funds, they often charge a 20% performance fee. So when the fund goes up, the general partners get 20% of the investment growth. The theory then is it's better to be the person getting the 20% performance fee than paying it. The problem I see is that these are typically billion-dollar investment firms investing on behalf of billion-dollar investment institutional clients. The next investment is pro sports ownership. Now, who wouldn't want to be the owner of a pro sports team, sitting courtside and hanging out with big stars, especially if you make a great return on investment while doing it? Tony points out some rule changes recently have allowed investment firms to start owning parts of pro sports teams. And hopefully then you too could be a part of that. Again though, these investment firms are often investing billions of dollars on behalf of billion-dollar institutions, and I don't quite see how the little guy is supposed to get a piece of those investment opportunities. Then Tony talks about private credit. Now, private credit is just a fancy term for lending a company money. You might be more familiar with the term corporate bond. Private credit is a place that's booming right now. Banks are lending to companies less. These companies still need money, but they probably aren't big enough to go through the time and expense of issuing a corporate bond. This is a place that a lot of million-dollar investors can get involved in. But the question is, should you? The promise of private credit funds are that you could get more return with less volatility than normal. The downside is that you'll also be losing a lot of flexibility and probably paying more in fees. Next, we read about what must be Tony's favorite investment, since he devoted 2 chapters to it: energy. Tony spends the first chapter talking about how the need for energy isn't going away, and the tilt towards what is called clean energy makes for an investment opportunity. In the next chapter, Tony suggests you could invest into energy-focused private equity and private credit funds, and that public energy stocks are undervalued. Tony then goes on to talk about venture capital and disruptive technology. His theory is that getting in on the ground floor with disruptive technology like AI or in the world of healthcare can give good investment returns, and that venture capital is the way to do that. He points out how the difference between the lowest performing and the best performing venture capital funds is huge, and that you typically need 10 to 25 million as a minimum to invest into venture capital. So yes, there is potential, but you would have to somehow pick the winners correctly ahead of time. And it takes a large amount of money to get involved. Again, we're hearing how these alternative investments are great. They're only available to the super rich, except at the end of each chapter, there's a website you can go to in order to learn how to buy these investments for the super low minimum of $25,000 through the company that Tony is part owner in. Now, I linked to that company, and the investment fund is the CAZ Strategic Opportunities Fund in the description. And as you read through the 89-page prospectus, take special notice that this fund is new. The prospectus is dated January 18th, 2024. There is a 3% charge upfront to buy in. a charge up to 2% to cash out, and an ongoing expense of up to 3.6% per year. Meanwhile, the average mutual fund expense, according to the Investment Company Institute, is 0.44%. That's almost 90% lower cost. I'll come back to Chapter 8 on real estate to talk about Chapter 9, secondary investments. The idea behind secondary investments is that when someone invests into a hedge fund or private equity fund, their money is locked up for some time. If they need the money early and can't cash out, then they could sell their investment on the secondary market to someone else who wants to get into the fund. Now, whenever you need cash quickly, you're usually willing to take a lower price on your investment. And the idea behind buying these secondary offerings is that you can now get into the hedge funds and the private funds at that lower price. Again, this seems to be a somewhat rare occurrence, mostly dominated by big billion-dollar institutions. In Chapter 8, we learn about probably the most accessible of these private investments, real estate. Tony points out that real estate is the world's biggest asset class. You're probably investing in this asset class already. You probably own your own home. And I often see the first foray investors make into private markets is through real estate, perhaps buying a duplex or small apartment building. Now, I'm not telling you to invest or not invest in real estate, but it's important to understand how the US tax code and financial system is set up towards real estate. Now, if you're someone who likes learning about different types of investments, this book will certainly show you that. I've been an advisor for 20 years, and I learned about some new ways to invest that I hadn't known before. But generally speaking, the tone of the book appears to be, here are some investments that are amazing. You have to be part of the club to get into these great investments. And by the way, here's a website where you can get in the club because you know Tony Robbins. So if you get past that part of it, you'll enjoy what I think is the best chapter. The last chapter called The True Holy Grail. Tony points out that money is not what makes you rich, that all the greatest treasures are not financial. He shares that gratitude and generosity is the key to a successful life. I absolutely agree with Tony there. And if you're trying to get more meaning and not just more money, then watch my next video where I talk about Bill Perkins' ideas on how to get all you can from your money and your life with his concept called Die with Zero.